Hello, everyone. I hope that you're doing well. This is going to be the last class of the semester. With this, we finish all the topics for this course. We still have a little bit of practice before the exam. I think we have an activity and homework, and that will be all for the course. So this is kind of the cherry in the dessert, where we are going to analyze a little bit about risk, which is an interesting topic on finance. So now that we know how to do some international financial management strategies and that we also know more or less how derivatives work, we are going to think about risk. Why is risk important in finance? So I think we'll have two videos in this class. These two videos are about risk in finance, in how you invest in finance. And I will try to convince you that if you go into the international market, you can reduce the risk, that it is a good idea to go international. That will be kind of the objective of these two videos. And in the first video, I will focus more on portfolio theory, which is something that I will explain in a second. And later on, we're going to move on to how can we calculate the risk on an investment portfolio. So that's more or less the agenda for today. And these two videos are quite conceptual. They're like they don't have much practice. It's only about understanding the concept. It's similar to like the pass-through concept. Do you remember that was only conceptual, or the first concepts that we learned in the first partial, like the forex market and the exchange rate systems, things like that, that we didn't put them into practice. We only learned the concepts. Where these videos are about that. So first, the first thing that I want to explain is what is a portfolio. So a portfolio, it's a combination of investing on two assets. So usually when you create a portfolio, you invest not in one, but in two or more assets. And what asset do I mean with this? It can be any financial asset. It can be like stocks, like in here, like in this example. So we have two stocks, stock one, stock two. This is one example. You can also have two currencies like dollars and euros. That's another example. You can have two derivatives. You can have two interest rates. You can have any financial asset, right? So in this example, we are focusing on stocks. So you have stock one and stock two. And as the example here, it says you have a combination of stocks. You have um, 200 shares of stock 2, which is worth 50 pesos each or $50. So you need to multiply 200 shares times 50 pesos or dollars, and then you have 500 shares of stock 1 at the value of 40 pesos. So you multiply this times this, and then 200 times 50, then you add up, and that's the value of your portfolio. Okay, so it's very simple. It's like if you have 10 apples and 10 oranges. That's also a portfolio, a very simple portfolio, but it's a portfolio of apples and oranges. And here is something interesting. If you have a portfolio, do you care about the price of apples and oranges individually, or do you care about the performance of both? I mean, imagine that you have one apple and one orange, to make it even more simple, one apple and one orange. So that's your portfolio, one apple and one orange. And imagine that one apple costs 10 pesos and one orange costs 10 pesos. Both cost 10 pesos. So the value of your portfolio is 20 pesos. So imagine that the orange goes up to 20 pesos and the apple goes down to 9 pesos. So are you happy or sad about that? I think you should be happy, right? Because in total, your portfolio now um, has a value of 29, 20 for the orange and 9 for the apple. So 29 pesos or $29. So this is something very interesting about portfolio theory. The first thing it says that, or the first assumption about portfolio theory is that investors care about the overall portfolio performance and not individual stocks or not individual assets. So if you think about this, you don't care or you are not sad because the apple lost value. You are happy because the orange gain even more value. So you have even more value than at the beginning. You have an orange that is worth 20 pesos and an apple 9 pesos, 29 pesos. And earlier you had 10 and 10 to 20. So you are happier because the overall portfolio performance it's better. It doesn't matter that the apple lost some value. So that is the first assumption. That's why portfolios are very interesting, because you don't have to be so stressed about individual assets or individual stocks or currencies or whatever. You just care about the overall performance. So that's something really good, because otherwise, if you care about individual stocks, it will be too stressful, and also it wouldn't be too profitable. So we're going to talk about this in later. And then another important thing, another important assumption, it is that someone who invests on portfolios likes good returns. That means likes profits, and doesn't like risk. Okay. So if I tell you, um, do you want this financial asset that has a 99% of paying you 10 pesos? Or do you like this other asset that has a 50% of paying you 10 pesos? So both will pay you 10 pesos, but one has 99% chance of paying you the 10 pesos and the other one has 50% chance of paying you the 10 pesos. What do you choose? In the end, you will choose the one with 99% chance of happening, right? Because investors dislike risk and investors like returns, okay? So that's a kind of a basic assumption about portfolio theory. So remember, these are maybe the two most basic assumptions from portfolio theory. First, that investors care about the overall performance of the portfolio. And second, that investors don't like risk and they like performance or expected returns. So let's think now about a national and an international portfolio. And here I want to tell you a story. It's actually more than a story. It's an experiment that some scientists did in the 60s, I think. The experiment was very simple. It, it was about a test where they hired, or not that they hired, they called people around the world, or around the US, I think, to create portfolios, like portfolios of stocks. Okay, so they had three groups. One group were like the best portfolio managers in New York, so the best of the best. They were group number one. Group number two were random people who didn't know anything about finance. That was group number two. And finally, group number three weren't even humans. Group number three were only monkeys, monkeys who had bananas with the name of stocks. So they asked the humans and the monkeys to create a portfolio. The humans had pen and a paper, and the monkeys had different bananas. So they asked them, these groups, to create a portfolio. So they asked them, can you uh, choose different assets or different stocks to create a portfolio? And we are going to measure the level of risk of that portfolio. So they did these three groups, and the findings are very funny, because in terms of risk, the three groups had this or very similar results. The three groups were okay with reducing the risk as much as possible. And how did this happen? Well, what happened was that the portfolio managers did a lot of calculations and a lot of math and blah blah blah, and they chose the optimal stocks, right? So in the end, they picked up, I don't know, maybe 50 different stocks. And normal people, they just pick up randomly whatever they liked, maybe popular stocks like, I don't know what was popular in the 60s, but maybe Coca-Cola and Ford and General Motors. So they picked up these popular brands and they pick up maybe very different assets. And monkeys just pick up all the bananas, right? So they picked up all the stocks that were available. So how was it possible that the three groups had the same level of risk, a very low level of risk. This happens because um, if you pick up different stocks or different assets from different industries, like for example, Coca-Cola and General Motors and Walmart, they're very different, right? One is beverages, the other one is automobiles, the other one is retail. And if you pick construction, so if you pick up different assets from different industries, different firms, different everything, what you are doing is something that is called diversifying the risk. So when you diversify the risk, that means that you are picking up um, things from different industries, different firms, different everything, right? So by doing this, the three groups did the same thing. The monkeys chose all the possible stocks. The top managers picked up different industries from different firms, and also people picked up different assets from different industries and all that. So in the end, after this experiment, this financial scientist came into the conclusion that if you choose about 20 different assets that come from different industries and different firms, and that they are not the same thing, if you pick up at least 20, you can diversify the risk at the lowest possible level. So I think in here, where is it? I think we have in here in the presentation, or I don't know if here it is. So theoretically, there is something that we call systematic risk, and systematic risk is the risk that we can't eliminate, right? So even though that you pick up 50 different assets, you still have some level of risk. If I make an analogy, it's like if you play football and you want to reduce the risk of getting an injury. So it is possible to reduce the risk if you warm up before the game, if you wear the right equipment, if you have the right shoes, if you, I don't know, if you are careful when you are playing, there is low level of risk from getting an injury. But since you are playing football, there will be always some level of risk that you will get an injury. So it's the same when you are investing in something. You can reduce the risk as much as possible, choosing from different industries, choosing from different firms, choosing from different things. But in the end, because you are investing, there is a there is some risk, a risk that it's from the system, from the financial system, because there is a chance that the whole system will collapse or that the whole system will lose its value, like what happened during COVID, right? Like at first, everything dropped its value. Now it's kind of recovering, but everything dropped from any industry. So that's systematic risk. That's why it's called systematic, because it comes from the system. It can't be avoided. So take notes about this, because systematic risk is the one that you can't diversify. You can't avoid this. But the one that you can avoid is the one that it's individual risk. Individual risk is the risk attached to a specific asset. Like imagine that if imagine that maybe the monkeys chose only one banana. Imagine that that would have happened. So if they chose only one banana, that would have a huge level of risk, because uh, imagine that you decided to invest all your money only in Coca-Cola. And so there is a lot of risk that maybe Coca-Cola will disappear and you lost all your money, right? So that's a huge level of risk. That's very risky. So you can lower or even eliminate individual risk, but picking up more than one asset. The magic number, as I told you before, is 20. If you pick up at least 20 from different industries and different areas, you are reducing this individual risk, almost going to zero. So in the end, you finish with only systematic risk. So let me show you that with some graphs that I prepared in the presentation. So first, I think I think I will first do the graph by myself, and then I will show you what I did. So the graph that usually investors look when they are creating a portfolio is a graph that looks like this. Is the one that I did in here. So you have in the y-axis the expected return, right? So this is the amount of profit that you can get. This is the expected profit that you will make from your investment. And in here, you have the risk. We use a sigma because that's a standard deviation. If you take maybe portfolio course, you will learn a lot about this. But this x-axis is the risk. So if you are more on the right, that means more risk. If you are more on the left, less risk. If you are more on top, you have better profit. And if you go below or you go down, you have less profit. So the best we can have, it's something around here. A lot of profit with not so many risk, right? That's the best thing we can have. And the worst thing we can have is a lot of risk and low return. So something like this, uh, it's not common at all. It's very complicated to find something like this. It's mm, it's not it will be very difficult to find something like this in here. And in here, it's a very bad financial asset. Something that doesn't pay that much and has a lot of risk is not common too, because it doesn't work. No one will buy it. So what we usually have is something different. Usually we have things that have low risk and low return, like for instance the T-bill or CETE for Mexico. That's very low risk because the government will pay, but they pay very low. So usually we have something in here: low payment, low risk. And usually we have the other way around. We usually also have something like this, like a lot of um, return, but a lot of risk. An example of this is maybe the bond from Pemex. Pemex is doing really bad right now. There are some chances, real chances that the company will mm, go to bankruptcy. So they pay a lot of money for whoever wants to invest in Pemex because they are not doing well. That's one example. Another example is maybe bonds from Aeromexico too, because they are not doing well at all, so they are paying more. So that's what happens. Usually you find something that pays a lot but has a lot of risk, or something that doesn't pay a lot but doesn't have much risk. So if you don't diversify and you decide to invest only in one, you are going to choose. So now let me change the color. And what you are going to do is that you are going to select maybe this point over here, like high return and high risk. That is one example, like Pemex, for example. Or you can go into a more safe place, or safer, sorry, place, like in here, like maybe, I don't know, bonds from Cemex. Okay. So what what you will do if you don't know about portfolio, or if you don't want to make a portfolio, is to choose one of these two, right? Like you can go in here or you can go in here. You can do one of these two. But what portfolios uh, do, or this is kind of the magic behind portfolios, is that if you decide to mix these two, if you decide to mix maybe 50% uh, of Cemex and 50% of Pemex, you are going to be maybe somewhere around here. Why is this possible? Why not in here? Why not in this line? It is because if you decide to mix the investments that you are doing, if you decide to mix them, it is possible to create something like this. Sorry, I did it incorrectly. You are going to create something like this. The possibilities will look, I did it wrong again. Let me erase, because I'm using the touch button. It's going to look something like this. And so you can have a lot of combinations, like maybe this, all of these combinations. It depends. Like you can do, you can maybe be around here, or maybe around here, or maybe around here, or maybe around here. But what do you think is the best area to be? It should be any of this area around here, like in this part of the graph, like this kind of boundary, like this limit. Why? Because if you want to reduce risk, if you don't want that much risk, you can choose to be in this point. And maybe this point is 80 CEMEX, 20 PEMEX, right? So you can say at this level of risk, which is still quite low, I can have more return than the one that I have in here. So this is kind of the magic of doing portfolios, that you can be in a better place without having to put everything in just one in just one asset. And how is this possible? Because remember what I told you in here. If you decide to invest in more than one asset, and if you go until 20, you are going to eliminate individual risk. That's why it's possible that this can happen, because if you invest in more assets, you are going to reduce the risk and you will have more return. So anyway, the nice thing is that you can invest in any point of this line. This is the optimal, because you can also choose to be in here. But does that make sense? Does that make sense that if I have this level of risk, do I want to be in here? No, because it's better to be on top. In here you have more profit with the same level of risk. So now I will show you the graph that I did. The graph that I did was between these two between two American assets. So one of the assets or one of the stocks will be in here and the other one will be somewhere in here. And what happens in here is that by choosing a different combination, you can maybe be in here with almost the same level of risk, like 0.55, but with more profit, 0.13 to 0.14. So that's very good. By using this portfolio, you can have a better outcome. And now I will show you what will happen if you add a third asset. If you add a third asset, it becomes even better. Look at this. Like here, if you wanted to have a 12.12 expected return, you should be around here, like 0.54. But in the next graph with three assets, if you want to make a return of 12, you could be in the level of risk of 0.45. And it is even better if you go up. With 0.45, you can have a rate of return of 0.15. So do you see the importance of investing in portfolios and not in individual assets? Because if you invest in portfolios, you can make a better choice of investing your money, and then you can have better expected return. The important thing in here is that in order to choose this point and not this point, because you can make a mistake, is that you need to be very good with finance. You need to do the calculations correctly to choose the right point. Because if I go back to the study with the monkeys, people who didn't know about finance, and the experts on finance, the ones who had the better expected return were the experts on finance, because they were able to find this point, right? So everyone picked up the lowest level of risk: monkeys, people, and experts. But monkeys probably were around here. Maybe they chose this point because they chose randomly. Normal people maybe in here, and the experts picked up the best return. Okay. So that's kind of the last part of the recipe. So first thing, or thing at first advice for your personal life or your company, or if you are going to have clients who are going to invest, is always invest in different assets and different industries, because on that way you can reduce the risk, and you can have something like this, like it's the same thing. You only added one more asset, and with one more asset you have a better graph. So that's first advice. Second advice: be good with um, with finance, so you can choose, or you can pick up the best point in the graph, because it doesn't matter if you choose 20 different assets, but if you chose the wrong combination, you might end up maybe here instead of here. So you need to pick up the right combination. And finally, this is kind of the point, or the objective of this video. What do you think will happen if you go international? If you decide to not only add a third asset, but you decide to go international? And I don't have it in here. Why it's not here? It's here. If you decide to add an international asset, it's going to look like this. It's going to look even better. I think here I added a Mexican asset, Bimbo. So if you add a Ford, which is international, look how the graph looks even better. At the level of risk of 0.55, which was the initial level of risk, where you gained 0.12, now you are able to make almost 0.22. That's really good, right? So this is the magic about portfolios. That's why people invest in portfolios and they don't invest in individual assets. Or some people invest in individual assets, but that's very, very risky. And it's not smart. It's smarter to invest in a portfolio. So the conclusion from this video is that, because this is the objective of the video, that's why I did this video, is to convince you that it's a good idea to go international when you are investing in portfolios. Like, if you go international, you are going to have more returns or reduce the risk even more. Why? Because if you think about the concept that I told you at the beginning with the story with the monkeys, if you add an international asset, then you are not putting all your money in one country. Because if you decide to invest only in these three assets, you are investing or you are betting everything on the US. But if the US goes on a crisis or something bad happens in the US, you are going to lose your money. So it's better if you decide to invest not only in the US, but also in Mexico, also in Brazil, also in Europe, also in Japan, also in Russia. Because then if something happens with one country, then other countries will do well, and then you can get more money from that. Usually, if one country is doing bad or one industry is doing bad, another industry or country is doing well. So you're going to get profit from the losses that you have from one country or the other. So that's kind of the end of this video. In the next video, I will show you um, why is it also important to go international if you have from the corporate perspective, because this is very about investing and portfolios. The next video is more about a corporation.